Thank you, Nirav. Good morning. We welcome you all to the Q2 earnings call of KEC. Let me start with an update on the overall performance for the quarter and thereafter talk about each of our respective businesses. We have delivered a consolidated revenue growth of 11% for the quarter with revenues of rupees 4,499 crores. The strong growth has been largely delivered by good performances in civil and T&D businesses. The growth could have been higher, but for the heavy rainfall in some regions of India and also some supply chain bottlenecks affecting both T&D and the civil businesses. Despite these challenges, we achieved a consolidated revenue growth of 18% for the first half of the year, which is in line with our guidance for the year. We have also delivered a remarkable growth in EBITDA of 54% in Q2 and 50% in H1. Our EBITDA margins continue to show an improvement every quarter. The EBITDA margins for Q2 have increased by 170 basis points, surging from 4.4% in Q2 FY23 to 6.1% in Q2 FY24. We are largely in line with our guidance for EBITDA margins of 6% for H1. As mentioned in our previous update, we are observing a noteworthy shift in our margin profile, primarily due to the substantial growth in revenues and margins from our UAE subsidiaries, SAE and KEC Spur, resulting in standalone margins being lower owing to the mix of projects under execution during the quarter. We expect an improvement in the standalone EBITDA margins as well in the forthcoming quarters with improvement in the India execution, especially in T&D and civil. We have delivered a robust growth in PBT of 148% in Q2 and 77% in H1. The PAT growth is slightly lower primarily due to a one-time reversal of a tax provision in the second quarter of the previous year. In terms of order intake, our YTD inflow stand at rupees 9,000 crore with T&D and civil businesses being the major contributors. We have a well-diversified and strong order book of rupees 31,320 as on date, a growth of 14% vis-a-vis last year. Additionally, we have an L1 position of over 4,000 crores, primarily in international T&D business. With this, our order book plus L1 position stands at over rupees 35,000 crores with a balanced distribution between T&D and non-T&D businesses. We continue to focus on working capital improvement, resulting in our net working capital coming down by 8 days to 140 days as on 30th September 23 vis-a-vis 148 as on 30th September 22. Our net debt, including acceptances, stands at rupees 6,339 crore as on 30th September 23. The increase in the net debt at 7% YOY is significantly lower than our revenue growth of 24% in the trailing 12 months. The interest cost continues to remain high at 4% of our revenue for the quarter and 3.8% for H1, primarily owing to the steep increase in interest rates and the elevated debt levels. Coming to specific businesses, our T&D business has achieved revenues of rupees 2,209 crores, a growth of 7% vis-a-vis Q2 last year. The growth has been slightly impacted owing to the challenges in the supply chain, both in transmission and substation projects, as well as significant ROW issues in some of the projects in India. During the quarter, we successfully commissioned the prestigious Warora-Kurnool transmission line WKTL project of 878 kilometers, one of the most challenging projects spanning across 3 states of Telangana, Andhra and Maharashtra. The project was commissioned despite the challenges of paddy crops, floods and severe ROW issues. These issues have resulted in some unforeseen costs during the quarter for which we are in discussion with the clients. The T&D business continues to witness strong traction in order intake with a robust growth of over 40%. The YTD order inflow stands at rupees 5,400 crores across India, Middle East, Africa, Europe, Australia and Americas. In India, the business has secured multiple orders from PGCIL and repeat orders from private developers. On the international front, the business has secured significant orders, especially in Saudi Arabia. These include our largest transmission line order within Saudi Arabia for developing the power infrastructure required for the development of NEOM, a visionary city in Saudi Arabia. We continue to leverage our Dubai facility to consolidate business in the Middle East. Our order book plus L1 position in Middle East has now expanded to rupees 5,000 crores approximately. We have also widened our presence in the power supply business with an order from Australia. Our unexecuted order book and L1 from tower supply business now stands at over rupees 2,800 crores, spanning across 6 continents. The growth in our tower supply business is a testament to our dedicated commitment to expanding and diversifying the tower sale business geographically. In SAE, I am happy to share that the business has delivered another quarter of turnaround performance with a stellar revenue growth of 51% and a positive PBT for the second consecutive quarter. Over the last 1 year, we have taken proactive steps to optimize our financial structure by refinancing a substantial portion of our local Brazilian loans. I am pleased to share that we have successfully brought down the average cost of borrowing to 12% per annum from 20% last year. The business continues to witness steady inflow of orders for supply of towers, hardware, and poles from the Americas. During the quarter, we also supplied our first hardware order to the US market from Brazil. The strong order intake has bolstered the order book and L1 position in SAE to almost 1,400 crores. As we look ahead, the business outlook appears promising. In the domestic market, we are pleased to share that in a recent announcement, the Cabinet has approved the Green Energy Corridor Phase 2 for 13 gigawatt renewable energy project in Ladakh with an overall cost of more than rupees 28,000 crores. As we assess the project specifics, this presents a substantial opportunity for us. We anticipate that tenders for this project will be released in the next few quarters. Internationally, we continue to witness a significant uptick in the Middle East and are actively exploring opportunities across SAARC, Africa, CIS, and the Far East. Overall, the tender pipeline for our T&D business remains robust, both in domestic and international markets, driven by the increasing emphasis on renewable energy and the need for new transmission lines, substation, and underground cabling. With a record order book and L1 in T&D of over rupees 18,000 crores, we are confident of delivering sustainable growth in this business. Our railway business has achieved a revenue of 776 crores for the quarter, degrowing by 12%, impacting the margins and the working capital of the business. The major reason for the slower project has been the delays in the availability of work fronts and heavy rainfall in certain parts of India. We have commenced execution of an international railway project in Bangladesh for signaling and telecommunication. I am delighted to share that our Honorable Prime Minister Shri Narendra Modi inaugurated the priority section between Saibabad and to Duhai of India's first RRTS last month. KEC is proud to have developed the Saibabad and Ghaziabad station viaduct and the Duhai depot for this first of its kind regional connectivity project. The order intake of the business remains subdued owing to the increase in competition from Tier 2, Tier 3 EPC contractors and the clientele changing from the railway PSUs to zonal railways. Consequently, we are also being very selective on the order intake front, considering the overall margin profile and the elevated working capital scenario of this business. Nevertheless, with a sustained focus of the government on strengthening the railway infrastructure, we expect the business to pick up momentum going forward. Additionally, we are also actively pursuing select international opportunities. Our civil business has delivered an exceptional performance for the quarter with revenue surpassing rupees 1,000 crores, stellar growth of over 40% vis-a-vis Q2 last year. The growth has been delivered by robust execution across all segments. I am pleased to share that the Honorable Chief Minister of Madhya Pradesh, Shri Shivraj Singh Chauhan, recently flagged off the trial runs of the Bhopal Metro. KEC is proud to have constructed the Bhopal depot for the Madhya Pradesh Metro Rail Corporation Limited. The business continues to fortify its order book with YTD order inflows of over rupees 2,000 crores. During the quarter, the business strengthened its presence with significant orders in diverse sectors, including metals and mining, FMCG, public spaces, and data center segments. Notably, the business has secured a breakthrough order for building a multi-speciality hospital and also secured its first ever order for setting up a manufacturing facility for a prominent global FMCG company. With the addition of a prestigious data center order, our portfolio now boasts of 5 data center projects across the country with a total capacity exceeding 100 megawatt. The business outlook remains healthy across segments. With a robust and diversified order book and L1 of over rupees 11,000 crore, we are confident that this business will continue to be a major growth driver for KEC. In oil and gas pipelines, the business has delivered revenues of rupees 127 crores, a good growth of 57% vis-a-vis Q2 last year. The business continues to be focused on building necessary pre-qualifications that will enable us to expand our addressable market. The order book of this business has experienced some restraint due to subdued tendering activities in the sector. Notwithstanding the same, the business has a strong order book and L1 of rupees 1,000 crores comprising government and private players. We are confident of scaling up this business in the coming years. In solar business, we are progressing with the execution of our largest 600 megawatt solar project in Karnataka. We remain actively engaged in bidding for select opportunities in this sector, capitalizing on the sustained commitment of the government to promote renewable energy. We believe this business will help contribute to our growth going forward. Our cables business has achieved revenues of rupees 413 crores, a steady growth of 6% vis-a-vis last year. I am happy to share that our transformation program for enhancing the profitability of this business is reaping results, as our cable business has delivered its highest ever profitability for the first half of this year. Over the last few years, we have concentrated on developing new niche and high margin cable products. This year, the business has successfully developed 5 new products, which are slated for commercialization. It is worth noting that these new products have made a significant contribution, accounting for almost 30% of the overall revenue generated by the business over the last 2 years. Overall, we are pleased with our consistent revenue growth and improving trajectory of our profitability in line with our guidance. The robust order book plus L1 of over rupees 35,000 crore and a strong tender pipeline of over rupees 1,25,000 crores. Notwithstanding the supply chain constraints, we are hopeful of maintaining our overall guidance on revenue of rupees 20,000 crores and 7% EBITDA margins for the full year. Thank you very much. We are now open to take questions.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Deepak Krishnan from Kotak Institutional Equities. Please go ahead.
Hi, sir. Thank you for the opportunity. Maybe I just wanted to check on your order inflow guidance of 25,000 crores. Given that we've just done 9,000 crores in 1/8, so
sorry, your voice is not coming clear.
Yeah, is this better?
Yes, thank you.
Yeah, so I just wanted to check on your order inflow guidance of 25,000 crores. Given that we've done only 9,000 crores and X of T&D, we could see some slowdown in the domestic business, especially railways and civil. So are we still confident of 25,000 crores, or should we end up closer to maybe 22,000 crores for the full year?
So Deepak, as of now, we are confident that we should be able to achieve that order intake. Looks at all order, but I think we have got a huge pipeline. As I said, 1,25,000 crores. We have quoted a large number of tenders, especially in India, in the T&Ds on the TBCB, where the auctions have just started happening. One did happen day before also, I think, and also in the Middle East. So I think as of today, if you ask me, we are pretty confident, and we don't think there's a need to revisit the targets. Maybe at the end of Q3 we may come back, but today I think we are okay with the numbers.
Sure, sir. Maybe just a question on your interest expense. I think for the full year we were expecting about 50 bips improvement interest cost as a percentage of sales, but obviously for 1H we really don't see that coming through. So what are the factors that are driving there, and extra, say, working capital expansion, what levers do we have to sort of bring it within the guided range?
So couple of points. One is I think for the H2 we are expecting the numbers to be between 2.8 to 3% or so, maybe 2.8, 2.9, because we do expect that our revenues for H2 would be at least 30% higher than the revenues for H1. So even if we remain at the same levels, the percentage to revenue would come down. I think overall for the year we would expect it to be around 3.25 or so, in that plus or minus 5 or 10 basis points here or there on the projections. Okay. As far as the levers are concerned, we did get some money from Afghanistan. We do expect some more monies to come in. Some of our monies from I'll say our viaduct projects, etc., DMRC, CMR, and also that has now started yielding, positive inflows. And there are other places where we are getting more cash flow. So I think we are confident that the numbers will start showing a declining trend. And especially if you look at the absolute increase in the top line which we expect for H2, we do expect that the numbers should look much more decent than what they are. We don't like the numbers very clearly. And if you want to look at a breakup, then almost 65% of our increase has come about because of the rate increase, and 35% increase is because of our elevated debt levels, which we are trying to, bring down.
Sure, sir. Maybe just one final question. What are the SCM issues that we are facing for revenue execution, both on T&D and civil, and how confident that we are that this gets sorted out in maybe the coming months?
So I think basically if you look at, and we are aware of what is happening on let's say conductors or transformers, GIS, etc. So they have become long lead items, and in some cases there have been delays. Effectively, I think if you ask me, we could have done probably another 400-500 crores of revenue in Q2 itself. Okay, but for delays in supplies, in one case, leading transformer, did not pass the test in the last moment. So, the revenue got deferred to, will come into Q3. So it's primarily, and it's both in India as well as in the European market, because most of our Middle East supplies come from Europe. And I think the next piece where we are seeing supply chain issues is in the supply of pipes for the Jal Jeevan mission. Okay. Clearly, we are all aware what the problems which we are facing in supply of pipes. So that's, I think, slowly, in the sense that it's already got delayed so much. So the supplies have started coming in from the earlier commitments, etc. So we expect that in Q3, large part of it should get settled. And by Q4, we have commitments of all the vendors to ensure that the supplies are done.
Sure, sir. Those were my questions, and best of luck for future quarters.
Thank you, Dev.
Thank you. Next question is from the line of Ashish Shah from GM Financial. Please go ahead.
Yeah, good morning, and thank you for the opportunity. So my question on the, good morning, sir. On the working capital side, while it is appreciated that on a trailing 12-month basis, we have grown by 24% and hence that increase in net debt and working capital, but let's say on a full year basis, do we see a net release of, operating cash flows, net release of working capital and positive operating cash flows, or even on a full year basis, our debt levels are likely to be higher than the previous year? Because, my concern is that at some point of time, if we continue growing and still the net debt absolute amount keeps growing, then at some point of time the balance sheet, appears very bloated. So, any direction on that, sir?
So clearly, Ashish, in the second half, we are, as Vimal just mentioned, we are expecting the interest cost to go down, and because of the higher revenue. See, basically where the problem is happening is on the interest rate rise, where across the economies, globally, the interest rates have been increased by all the central banks, and the most of the hike actually, if you look at RBI did in the previous financial year. So that impact is now getting reflected in the numbers. Our average cost of borrowing, which used to be about 5.5% or so, has now reached to about 8%. So clearly, because all our debt is basically the working capital for the business, and that is where it is immediately gets reflected in the numbers. So 2.5% increase by the RBI over the last 1 year has actually impacted us on the higher interest cost. As far as the business is concerned, we are clearly focusing on reducing the working capital, and which is quite visible in terms of the NWC days. So we should really focus on the NWC days, because last year we had a revenue growth of close to about 26-27%. This year also in the first half we have grown by almost 18%. So revenue growth is also definitely will require additional working capital. So there is no question about that. That you can do with the 3,500 crore working capital, you can do 20,000 crore revenue. It's not possible. So we should really focus on the NWC days, which is clearly 140 days, 8 days lower than the last year, despite a 24% revenue growth. And in the second half, we are expecting another 30% revenue growth compared to the H1. So overall for the year, we are somewhere between 15 to 20% revenue growth for the full year. So that will definitely have an impact on the borrowing number. So borrowing will definitely be higher, but we should rather focus on the NWC days, which clearly we will bring it down in the second half, and with the collection happening in Afghanistan, collection happening in some of the state electricity board where the money was stuck. So all those things are happening, and they will have positive impact in the second half of the financial year.
So let me add one more point here. Is if you look at the composition of our net working capital, what has happened is the debtor days have come down significantly. Unfortunately, the creditor days have come down more. So that's otherwise had we maintained our creditors at the same level as earlier, then our NWC would have come down more. And there are a couple of reasons for it. One of the reasons is that our civil business is expanding, where supply is less and more of construction, and where the payouts are happening a bit faster, although their NWC is much better than other businesses. So we are trying to see as to how do we sort of match the ARs and the APs to help us in improving the NWC further.
Right. So, sir, at the company level, where would you expect the net working capital? Are we on track for close to 120 or 110 days, or that we have been targeting?
So our aspirational target has always been 100 days. Okay, that's the aspirational target. So at least I think a 10-day improvement is what we are looking at by the end of this financial year. Are you 110? Okay, are you saying 110? I don't know.
So we are committed, Ashish, to bring the NWC days back to 110 days by end of the year.
Got it, sir. And just a last thing from my side on the margin side. So we've been close to 6% for the first half. For the full year, are we on track to be at close to 7% or thereabouts?
I think, Ashish, the endeavor is still to be there at 7%. Okay. So I don't think that should be a very big challenge, but it could be still 10-25 basis points here and there, because we're clearly seeing the supply chain pressure, although it's improving a lot. Okay. But then there are ROW issues which we are facing both in Gujarat and Rajasthan, etc. So it may change the composition of the revenue. So it's just a question of whether we do 10-20 basis points less or more. But we expect it to be around that number.
Got it, sir. Thank you very much.
Thanks, Rajesh.
Thank you. Next question is from the line of Amit from Prabhudas Lilladher. Please go ahead.
Hi, sir. Morning. Thanks for taking my question. My first question on the order prospect, which you have highlighted in the international market for railway, civil, and oil and gas. If you would like to highlight the addressable market and prospects and which countries we are actually looking, and how much can come in next 12-18 months?
So difficult to put a number as to how much can come in the next 12-18 months, but if you ask me countries would be, one is our neighboring countries, which would be Bangladesh, Nepal, etc. Middle East is one where we are looking at more closely, especially for civil and railways. And the third area where we are talking about is in some countries in West Africa and other. But basically, I'll say in Africa, we have already put in some test bids in Africa and Middle East for railways and civil. Hopefully, as I said, railways, we already started execution of one order which we had received. And if we are, God is kind, maybe we'll get at least one or two more orders before the end of the financial year in either civil or railways.
Right, sir. Sir, also on this 1,25,000, this pertains to domestic or T&D, any color, or this includes all the segments, the prospects which you have?
So let me give a very broad breakup. It includes all the sectors, but if you look at only transmission, it would be around 70,000-75,000 crores is basically only transmission. Okay. Roughly around 20,000 is railways and another 20,000 is civil.
Right, sir. And how about BCC? The transmission order in international markets? Is that prospect also included here?
Sorry, I'm not clear. What do you want to understand, Amit?
So the T&D orders in GCC, where we are saying, the enhanced capex happening, and the order prospect already included here?
So we talk about order pipeline, tender pipeline.
Yes.
So tender pipeline in GCC is roughly around 30,000 crores as of today.
So that is included here in 1,20,000?
It is included in 125, yes.
Okay, sir. Sir, on margins for standalone T&D, where we are facing challenges, what are our internal targets in 12-18 months in domestic T&D margins?
So 12-18 months, we are clearly looking at going to double digit, but it will be between 8 to 10%, which has been our standard numbers. Okay. So next year, definitely, we will be at least 8%.
Sure, sir. Thanks. That were my questions. Thank you.
Thank you. Next question is from the line of Priyankar Biswas from BNP Paribas. Please go ahead.
Yeah, hi, sir. Priyankar here. Thanks for the opportunity. My first question is, sir, as you were highlighting that your creditor days has actually gone down. So I was unable to actually completely understand the explanation. So what is actually leading to this shrinkage? And how should we be looking at it, let's say, in the next few, let's say, quarters or maybe the next year going ahead?
So basically, there are 2-3 aspects to it. One, is a seasonality impact. If you generally look at our past years also, in the first half, because Q4 is always very heavy in terms of the revenue. So there's a lot of buying which happens in Q4. So that gets paid off in quarter 1 and quarter 2, and that is one of the reasons, these creditors are looking lower. Second reason is that, our railway business is actually shrinking. So it has actually degrown in this quarter by almost 12%. And new orders are not coming up. So that is also leading to some actually payment of the earlier acceptances, which is actually, and new buyings are not happening because since the new order intake for this half year was only 750 crore. So effectively, the new purchases of material, especially on the bought-out items, did not happen in the first half of the year. So that also led to some, reduction in the payable days or in terms of the acceptances. So that is the main reason. But, clearly in the second half, when we are talking of a revenue of almost close to about 11,000 crore, so that will add to a lot of acceptances, and that is how the this build-up will happen again. So that will lead to the better working capital and reduction in the NWC days also.
Okay, so that's well understood. So another question here is, so what we are seeing now is like a lots of launches in real estate, and then of course significant capex happening in data center. So can you just elaborate on the prospects here a bit? Because, see, in 2Q of FY23, we had fairly substantial civil orders flowing in. So we didn't see it this time. So based on the visibility, maybe the 2H, and how do you see FY25 essentially on these fronts?
So one is, if you look at our revenue targets, and I think we do expect that civil next year would again grow by 30-40% definitely. Okay, so that's one part of it. This year we'll definitely cross a revenue of 5,000 crores. So next year we should end up with at least 7,000 crores of revenue as far as civil is concerned. Okay, we're already with a L1 plus order book of almost 11,000 crores. Okay, and we have around 20,000 crores of tenders to be quoted in the civil business. And I completely agree with you. A large part of the order tender pipeline is coming in from real estate. Second piece is metals and mining. Data centers, yes, their numbers are coming up, but it's not a very large volume in terms of whether we'll be able to do 2,000 crore of revenue. I don't know. Maybe 500, maybe 1,000 crore today. Once we start doing MEP of data centers, maybe the values may still go up. Right now we are doing, except for one project, we are doing the civil piece of it. Okay. So I think we are getting into MEP, so that should go up. So I think if you look at where the orders are going to come, it's going to be public spaces. It's going to be part of industrial. We have started seeing, cement orders now, people talking about cement. Surprisingly, we're also seeing a lot of inquiries about commercial buildings, which we did not discuss before. We are right now doing, I think, 2 or 3 of them, and we are having more inquiries on commercial. So I think, to me, if you ask me, next year the order intake should at least be 10,000 crores on civil. This year we're targeting around 8,000. So next year, with the growth of what we have, should be around 10,000 crores.
Okay. So this year you were saying that we should broadly be around FY24 should be broadly be around 8,000 crores civil.
That's our target. Yeah.
Mm-hmm. Sir, just one further split I need. When you were speaking of the prospects of 1,25,000 crores, so what would be the international within this?
International within this is roughly around 50,000 crores.
So mostly it is mostly even the transmission is also largely India this time.
The 50,000 crore what I'm talking is only international T&D. Okay.
Oh,
and India T&D, as I said earlier, is roughly around 30,000 crores.
Okay, sir. That's all from my side. Thank you, sir.
Thanks, Priyanka.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Abhijit from Yes Securities. Please go ahead.
Good morning, sir. Thank you for the opportunity.
Yeah, Abhijit.
Sir, we have seen some moderation in T&D revenue growth in this quarter. You highlighted a few issues pertaining to supply chain and ROW. So, sir, are we cautious in terms of further order bidding in the domestic T&D segment because of these issues that we are facing? And
Abhijit, sorry, but you are losing your audio in between. Can you please speak through the handset?
Is it better now?
Yes.
Yeah, go ahead.
So I'm saying, are we cautious in terms of further bidding in T&D domestic business because of the issues that we are facing right now? And how should we look at the revenue growth going forward for the business? I mean, given that we have seen some moderation in this quarter.
So I think, Abhijit, what is also happening is that the clients are also realizing that the delivery timelines for some of the items have increased. Okay. That is one part which is happening in the new tenders. Definitely we are cautious, especially cognizant of the timelines of what we are bidding. I don't think it is still at a stage where it will impact the growth of the business. Also keep in mind that most of the suppliers are now expanding their capacity, whether it is conductor, whether it is transformers. GSI was in Saudi 2 weeks back and we could see all the suppliers wanting to expand capacity. So I think clearly we are seeing that the way the demand scenario is getting panning out for the next few years, the suppliers have been waiting for this and now they are seeing that there is an opportunity, so they are looking at expanding their capacities. So I think, last year, I'll say current year and all was an aberration because people had not expected the T&D business to pick up so much. My earlier calls also, we had been a sort of negative on T&D business. All of a sudden, the business just turned around and is galloping. So everyone, including us, the suppliers have been caught napping. And now suddenly we are finding people are adding capacities and all that. So I think to me, it's more of a temporary phenomena. Maybe in a couple of quarters, the capacities will also increase, which will be enough for the growth which we are looking at. Am I worried about it? No, I don't think we are worried about it. It's just a temporary blip which has happened in, quarter to quarter and all that.
All right. Sir, also, in terms of the railway business, like this quarter, practically we have seen the order inflow drop substantially. And you mentioned the reasons, highlighted all the reasons in the PPT also. But sir, going forward, are we like, how are we looking at the business in terms of bidding for the incremental orders, given the weakness and given the competition from tier 2, tier 3 suppliers? So, how do we look at the order inflow for the business in the next 2 quarters?
So I don't think we are very positive about the order inflow on this business. That is why when the first question was asked on the order intake, I said, we do hope that we'll be able to maintain our order intake because some part of railways definitely was baked into that, and we are seeing how do we replace those order intake. See, as far as railways is concerned, what is happening is that there are 3 or 4 different buckets. So one of the buckets where we have been losing orders and unfortunately where many orders have come has been on setting up of new lines, etc., where there is a lot of, I'll say, earthwork and civil and all involved, which is where most of the road contractors and local contractors have started coming in, especially because these orders are now not coming in from RVNL or RITES and all, but coming in from the divisional railways. So that piece is something which is sort of virtually out of bounds for us now, because we are not getting orders, or the margins are so low that we don't want to take those orders. So where the orders will come in for us is like, your TICAS and all that, where I think there is some discussion now, and I think in December, January, we will see some orders coming in. We talked about auto block signaling, then also on the 2x25, which is for speeding up the trains, and also some of the metro orders. And we have bid for a few orders in international, so I think at least one of them should come in railways during this financial year. Right now, we are not very, I'll say, not aggressive or not very bullish on the order intake of railways. We would love to first complete the existing orders and all that, and then relook at which segments we want to do and how we want to do.
Right, sir. So lastly, on the average cost of borrowing, you mentioned that it has increased to around 8%. So, what is the expectation like going forward in the next few quarters? This number, would it go up, or it is going to be around these levels?
So, as far as Abhijit rate is concerned, I don't think that we are looking at a further increase in the interest cost per se, interest rate per se. So, interest rate will remain at around 8% or so. Because what RBI has not hiked the rates post, I think the February 2023 was the last hike that was done. And this time, fortunately, yesterday also there was a Fed meeting, and Fed also not increased the interest rate. So they have paused after a long time. So I don't think the rate should go up further. But at the same time, we are expecting that the rate will not go down at least for next 6-8 months. So probably the reduction may start happening on the rate front probably in the second half of the next calendar year, not before that. But our cost of borrowing will remain around the current level at least for some time.
Okay, so next 4 quarters, you are saying the cost of borrowing would remain around these levels?
At least three quarters for sure, yeah.
So I think, Abhijit, what can probably change, although Rajiv is not accepting it, is that with our international business growing so much, we're also looking at how do we, get some better rates from international financing, etc. So let's say from Middle East, Saudi, and other countries, etc. So those efforts are going on. Let's see if something can happen out of that. Maybe there could be some impact on these things. Yeah.
Right. So thank you. That's it from my side.
Thanks, Abhijit. Thank you.
Thank you. Next question is from the line of Shubhadeep Mitra from Nuvama Wealth. Please go ahead.
Good morning, and thank you for the opportunity. So firstly, just a little bit of more color on the debt front. So wanted to understand that has there been any movement or reduction in the overseas debt, and how do you see that piece panning out and its interest on its impact on the interest cost?
So there is no reduction in the overseas debt. So in fact, it has slightly gone up, and that is by design, not by default, because there are a lot of orders which are coming in from the Middle East market and from the international market. So to that extent, we have, and there is a large amount of power supply orders which have helped us to increase our foreign currency debt, and that is helping us in a way to control our cost of borrowing and reduce our rate of interest. So it has only gone up, it has not come down.
Understood. And with regard to the exposure on the Brazil side of things, that has started coming up?
So Brazil debt, overall debt has been reduced. In fact, in this quarter 2 also, we have infused some additional equity to reduce the overall quantum of the debt. And the entire debt portfolio has been restructured in such a manner that the interest cost now for Brazil has come down from 20%, which was there about a year ago, has now come down to about 12%. And now the Brazilian central bank has also started cutting the interest rates. They have already cut 50 basis points in the previous quarter. So we expect that the interest rate in Brazil should go down further as the central banks have started cutting the interest rate. So that benefit will also come in Brazil.
Understood. And what would be the total amount of debt on the Brazil side right now?
So it would be approximately equivalent to $50 million.
Understood. Perfect. That's it from my side.
Thank you.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Abhineet Anand from 3P Investment Managers. Please go ahead.
Yeah. My first question is, civil we have done quite well. Just want to understand where would be the EBITDA and PBT margins here in this presently?
So the EBITDA margins would typically be around 8% or so right now. Okay. PBT, I don't have the exact number, but I think civil, the NWC is around 70 days. So it would be around 5% or so. Rajiv?
Yeah, absolutely.
Yeah.
And our mix of international and domestic debt, what we have presently?
I don't know, Rajiv.
So it is, at present, it is roughly about 70-30. So 70% is domestic and 30% is international.
Okay. Any forex gains or that we have had during 1H of this year, sir?
Negligible.
Hardly anything. I think that's 100 crore hoga. What come? Yeah.
Okay. And lastly, this UAE and SAE margins have improved. If you can just let us know 1H what have been the margins there broadly?
I don't think we have the margin figure right now with us. Why don't you speak to Abhishek later on and get the numbers, no?
Sure. Thanks. Those are my questions.
Thank you. Next question is from the line of Tina Vermani from Motilal Oswal. Please go ahead.
Hi, sir. Thanks for taking my question. My question is regarding the Middle East order book, which you mentioned that it is somewhere closer to 50 billion. So how are margins and working capital in those projects, particularly from Saudi?
So, if you ask me, the margins are slightly better than other margins. They are improving now because the business is growing, the tender pipelines are growing, so we are all trying to push the margins up. And I can see an increasing trajectory there, number one. Number two, if you look at per se Saudi, the payment terms they were not very great. I think we are seeing a change happening with the client. We had a meeting with the client where we also discussed this last week also, and when they are looking at improving the payment terms. Thirdly, what is happening is that 50 billion which I talked about also had tower supply orders which are from that region where the payment terms are much better. So if you aggregate all of them, I don't think the payment terms are significantly adverse to what we see at other places. Okay. Also, I think we are seeing that the execution pace is picking up there, which is helping us in realizing our retentions and all payments more faster than before, with the client becoming a lot more flexible than earlier. So I think we are quite okay with the payment terms there in the Middle East now.
Okay. And in terms of the margins, like you mentioned that they are slightly better. So are they in the range of 8-9%? One can safely assume that for the Saudi project?
So to me, some of the existing orders would be at that level. I think the new orders, we are trying to improve the margins. Okay. Our aim is that we start getting double digit on these orders on the fresh ones. Looking at the order pipeline and the order book of many of the large players, I do expect that, especially in Saudi and all that, the margin should start inching up.
No, but they are all on fixed price basis.
They are on fixed price. But what has changed, Tina, is that now in most of the cases, the metals get reset on the date the tender is awarded to you. Okay. So earlier you were carrying two different risks. One was the risk when if between bidding and award, if the prices change, then you had that risk because you were not sure whether you will get it or not.
Right.
And then you had the risk of carrying it further till execution. Now what has changed, especially in Saudi and UAE, it was there earlier, is that the metals get reset on the date the contract is awarded to you. So on that date you can go and hedge it. So although they are fixed price, but it's a hybrid concept now. So you have the opportunity of hedging your metals, especially I'll say copper, aluminum, and zinc, on the day the contract is awarded. So the risk comes down significantly.
Got it, sir. Got it. Thank you so much, sir. That's it from my side.
Thank you.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Riya Mehta from Equirus Investments. Please go ahead.
Thank you for giving the opportunity. My first question is in terms with, you said that there are a lot of supply chain issues which are happening in the T&D aspect. So could you elaborate more on that? And also you said on Jal Jeevan there is some pushback from the pipe companies to supply. So what is actually happening, and could you elaborate on that?
I think on the Jal Jeevan, it is very simple that the orders which have come out are very large in number. There are many states which are giving large orders, and I think some of them more also because of forthcoming elections, etc. People want to give orders and ensure that some work is done. So clearly, the supply side is not keeping pace with the speed at which the execution is likely to happen, which is their pressure. But I am seeing a lot of players have now started expanding capacity. At least I know one or two people whom I had met personally, they are expanding capacity. So we do hope that, the situation will ease out. And especially what will happen is that with the elections coming in, I don't see new orders after March, April, at least beyond March. So the pressure on the supply will start easing off, and also with the capacity. As far as T&D is concerned, I think there has been some pressure on specific high capacity conductors, which is what are being used especially in the TBCB project. So there's no general shortage of conductors and all that, but for specific varieties which are more preferred on account of IRRs and other concepts and all that. So all the players are now asking for. That's where there has been some concern. Also in Saudi, with the focus on Saudiization, most of the orders are now have to be supplied by the Saudi vendors, by local Saudi vendors. That has put some pressure on the Saudi side. And third piece is also on the substation OEMs, where with the problems which we had on power prices and then labor in Europe, that has put some pressure on supplies from Europe. But I think going forward, all these are getting factored into the tenders, not only by us, by the clients also. Now the clients also know that you will not get a transformer for 12 months. So that's how the tenders are changing. So I think going forward, we should be okay, and we should be able to maintain the margin projections or the revenue projections which we are now factoring in.
Right. Yeah, that's it from my side. Thank you so much.
Thanks, Riya. Thank you.
Thank you. Participants, you may press star and 1 to ask the question. Next question is from the line of Mehul from Nuvama Wealth. Please go ahead.
Good morning, team. Thanks for the opportunity.
Mehul, sorry to interrupt you. Can you speak a little louder?
Good morning, team. Am I audible?
Yeah, Mehul, go ahead.
Yeah, thanks for the opportunity. If I heard you correctly, for H2 revenue, you have guided for 30% growth over H1, I believe. Is that correct?
Yes.
So that means that revenue would be flat, near about for FY24 as a whole?
Sorry, I didn't get that part. What are you saying?
So for FY24, if I take this 30% growth over H1 revenue, then we should be more or less flattish or kind of single-digit growth over FY23 in terms of revenue growth?
I don't think the numbers are correct. We have been saying should be around 20,000 crores of revenue, which would be around 15-17% growth is what we have been targeting. Okay?
All right. And
I think we have done around 9,000 this quarter. Okay? H1 we have done around 9,000. So 11,000 is what we are talking. That will take to 20,000.
Okay, my mistake. Maybe I got it 7,000 crores. So anyway, it's fine. And in terms of order inflows, I believe you are guiding for 25,000 crores for this year, we should be achieving. And last year it was about 22,000 crores kind of for FY23.
Absolutely. That has been our guidance for the year, that we should be around that number, yeah. I think one thing, Mehul, which I would like to add is that right now almost 20% of our revenue is coming from product sales, which is towers and cables and all that, where it is more like book and bill supply. Okay. So when you look at the order book backlog and the ratio of order book to sales, some of these parts need to be excluded in the terms of, for EPC it would be 1.5, 1.6 times. For us, generally we have been 1.4, 1.5, unlike other people, where our execution has been much faster than other people in terms of the ratios. But in our case, since 20% is now coming in from supplies, that order book would be more, coming, let's say for next year, most of it will come in Q1 or maybe Q4 and all that. So I think that factoring you should do in the order book versus revenue.
Understood. And sir, is it that I believe that railway piece, wherein order inflow to an extent is getting impacted, that is why that this 22,000 crores guidance is for 25,000 crores. If that would have worked, maybe growth would have been higher than that.
No, that was factored in. No, our normal railway order intake was factored in 25,000 crores. Okay. So now the railway is going down, so we are trying to see how do we push our civil team or TNT team to make up for that. Okay, but we think we'll be able to make it up.
Okay, got it, sir. Thank you.
Thanks, Mehul.
Thank you. As there are no further questions, I would now like to hand the conference over to Mr. Kejriwal for closing comments.
Thanks, Nirav, and thank you everyone for your continued interest in KEC. Thank you so much.
Thank you very much.